In this module, we will continue our exploration of IAS28 and proceed to inspect the impact that the presence of an associate has on the workings and adjustments required in order to prepare a set of consolidated financial statements. The consolidated statement of financial position will be prepared using standard consolidation procedures as discussed in a separate section of the course material. That is by combining the assets and liabilities of the parent and its subsidiaries on a line-by-line basis. As we remarked in the previous video, the associate will be included under non-current assets in a single line, whose carrying amount is computed as the cost of the investment made, plus a share of the associate's post-acquisition gains or losses, less any dividend distributions received, as well as any potential impairment losses. The carrying amount of the investment in the associate will also be adjusted downwards for the parent's share of any unrealized profit in inventory, an adjustment which we will be discussing in the next video. At the same time, the group income statement will include a line to reflect its share of the associate's results, which will subsequently be attributed to the group's retained earnings. Any dividends received from the associate will, however, have to be eliminated from consolidated profit or loss. You will have probably noted that the expression for the carrying amount of the investment in the associate, as reported in the consolidated statement of financial position, includes a reduction for potential impairment. This is because, in addition to the recognition of the investor's share of the subsidiary's losses, IAS28 also requires preparers of consolidated financial statements to apply criteria contained in standards applicable to financial instruments to determine whether it is necessary to recognize additional impairment losses with respect to the investor's involvement with the associate. The details of this exercise are, however, beyond the scope of this course. If the fair value of the associate's net assets at acquisition are materially different from their book values, the net assets will have to be adjusted to their fair values in the same way as is done in the case of a subsidiary. Such adjustments will also impact the share of the associate's gains or losses recognized in the consolidated profit or loss account, as the subsidiary's depreciation expense, for example, will have to be adjusted so as to reflect the fair value of the underlying non-current assets. It is important to note that if the associate is loss-making, the investor will recognize their share of the associate's losses until that share equals or exceeds its interest in the associate. In other words, until the carrying amount of the investment in associate account drops to zero, at which point the investor should cease recognizing the associate in their books.